Webinar started.
Hi, everybody. Welcome to today's webinar. We've got a group of people that are going to cover what's going on today in the office sector. So I assume if you're attending, you have some interest in office loans, office properties, and we've got an excellent slate of people. I'm going to go ahead and start. If you can go ahead, Sarah, and turn it to the other page, you'll see who the speakers are here in a minute. I'm Ann Hambley, the founder and CEO of First Service Solutions. And I'm actually the picture on the very left there, that young, beautiful, actually me, the names got switched, but anyway, the real Stephanie, now you can introduce yourself.
Hi, I'm Stephanie Whittington. I'm SVP of Operations for First Service Solutions. I've been with the company for about 10 years now, or almost 10 years, and have handled over 600 loan assumptions, and I handle all of our performing loan transactions.
I will add to this for her because she's too modest to say it, but I believe she's handled more assumptions than any other human that I know of in our business. So anyway,
I've done way too many, way too many for one person, but yeah, we keep doing them.
Douglas.
Yes, Douglas Scott, Senior Director of Workouts. I handle the non-performing loans. I've been with First Service Solutions for a little over 3 years. Part of that, asset managing commercial real estate portfolios across the U.S.
And we're very honored today to have our guest speaker, Greene. Greg's an Executive Vice President at CBRE in the Debt and Structured Finance Group. He's been with the company for over 20 years, and he and his partner, Scott Lewis, lead a commercial real estate mortgage brokerage team that's very active across the whole U.S. Last year, I think I heard that your little team financed over $2.7 billion in real estate and $1.5 billion in debt. So you've been very, very active in the last little bit here. And you hold a degree, Greg holds a degree from the University of Texas and the University of Alabama. He's a CPA and holds a salesman license for real estate. And I can attest to the fact that he's a frequent speaker on real estate topics. He did a presentation I was privy to a couple of weeks ago for the counselors of real estate. And I think you'll find his presentation very, very informative. So first half hour of this presentation is going to be Greg talking to us about the commercial real estate market for the office specific property type. So Greg, look forward to this.
Hey, thank you, Ann. I appreciate that. Just give me a moment here to get these slides up.
After Greg's done with his presentation, we're going to go ahead then and Greg's going to paint the picture of what's going on in commercial real estate relative to office. And Greg, I know, told me I want to do this presentation and I just don't want to make it too negative. So I'm sure you won't. But when he's done, what we're then going to go into are the options. So what options do you have as an owner, given that you might have an office property in commercial real estate in this day and age? So as you can see, we're getting Greg's slides up. Sorry for any technical difficulties, I guess they say, right? But you'll hear a lot of good information today, so it's worth a wait here in a minute.
Yeah, Ann, give us a moment. We're having a little bit of an issue on my end. Hold on.
Okay. All right. Well, what maybe again to kind of give you a little preview as to what we're going to talk about later. My team came up with 7 options you have available to you if you have a commercial real estate loan on an office building. So you're going to hear about 7 different options. And I think we were surprised that we came up with 7 because it's hard to imagine more than 1 or 2 if you're an owner. One is, keep paying everything forever out of pocket, and the others hand the property back. But we're gonna show you that there are plenty of other options. Go through that. Oh, I think we're almost there, Greg. Yeah, there we go. Okay, so with that, let's hand it over to Greg to start his presentation.
Okay, can you see, you can see my slides here now, Ann?
Yes.
See the-
Yes.
Okay, and on full screen?
No, but we'll live with what we got if you
Okay, well, let's see if we can get this right again. Just give us another moment.
yeah. No, it's funny, in our trial run a few times, it all worked perfect, right? It's always the case. Then you put it on live and we have difficulties.
Hey, Greg, at the top, it's the display settings that'll have you flip. There it is.
There it is. You're on, Greg.
That's full screen. Perfect.
It is full screen?
Full screen.
Yes, sir.
Great, thank you. Okay, sorry for that. And again, thank you, Ann, and it's my pleasure to be here today and my pleasure to have the opportunity to speak to this group. And I'm going to talk for about 25 minutes or so, and hopefully we'll have some time for questions at the end. And at the end of the hour, my slides are going to lean heavily on the work of CBRE Research and CBRE Econometric Advisors. So my thanks to Richard Barkham, who's our chief global economist, and his entire team, both in the United States and globally. So let's go ahead and get started. I do have lots of slides. We'll move pretty quickly. And if anyone would like the slides, they are certainly yours, and we will make them available to you. The four primary topics that we're going to talk about today, we'll start with human nature. In 2016, or maybe even before, we were told that bricks and mortar retail is dead, that it was killed by a conspiracy between Amazon and the internet. And what has the real estate response been? Well, today retail is a very desired asset class by both equity and debt. I was not at the ICSC recently, but the people that I talked to who were there said that it was very positive. 2019, we were told hospitality real estate is dead, result of COVID-19. And I think anyone who's traveled recently knows that the travel industry is back in a big way. In 2010, the BP oil spill occurred, and we were told that the beaches were going to be uninhabitable for a lengthy period of time. But many real estate people and oil and gas savvy investors immediately went to the coast and started buying real estate at 50 cents on the dollar, and they were extremely well rewarded for having done so. And the message here is this. This is from Benjamin Graham, and I'll give you a moment to read this to yourself. The message here is this. Yes, this is a difficult time in the office capital markets. There's no question about that. But this is not the first time that we have seen this kind of difficulty, and it's not going to be the last time either. The message is this too is going to pass. So today's office capital markets, here's a few observations. Just generally speaking, across all office across the country, values have fallen about 30%. CBRE expects continued decline in values until we get to about a 34% drop in values across the country. It's difficult to value any given property right now. Price discovery is underway. But it's difficult because of the small number of transactions that have occurred in the last 12 months. One thing we know for sure, though, is the very best properties continue to do very well. And the reason is a lot of tenants have chosen to use their office space as a weapon, as a way to recruit and retain their employees and get them back in the office. Currently, office vacancy is approaching 18%, and that's the highest rate in the last 30 years. We've been waiting to see and are finally starting to see more and more all cash buyers come into the market who basically say, look, we're going to underwrite to X, whatever that is, on an unlevered basis, and that is our proposal to buy the property. And if there is some seller financing available that is accretive to the deal, then they would likely take that on top. But we are seeing more all cash buyers, and we've been expecting this for some time now. Capital markets, as I'm sure everyone knows, are way off. Last year from Q1 22 to Q1 23, 71% reduction in office value in office transactions. I mentioned retail just a moment ago. Retail was down a much relatively lower 32%. The demand for space, though, remains positive, and from 2010 forward, those buildings continue to do particularly well. You can see it's the older buildings that have had more difficulty coming all the way back to Q1 of 2017, but especially when COVID hit, you can see the impact on occupancy in those buildings. But the newer buildings, no surprise, have continued to perform best. That's that kind of yellow or gold color that you can see. Said differently, again, the 2010 vintage buildings and newer continue to outperform. You can see they have a vacancy rate of approximately 14%. That's about 400 basis points higher than what it was pre-COVID, but you can see that those continue to outperform the older vintage properties. I want to introduce the concept of hardest hit buildings. The CBRE took a look at the three-year period between the first quarter of 2020 and the end of 22, and basically said there's been a lot of incremental vacancy that's come with COVID. And where is that vacancy occurring? And what they found, and I find this just astounding, but across the 20 largest markets in the United States, 80% of the additional vacancy, this incremental vacancy in this period of time, 80% of that fell in 10% of all the office buildings. So 10% of the buildings have absorbed 80% of the incremental vacancy. Again, I find that quite surprising. The majority of these hardest hit buildings were built between 1980 and 2009, but that's a 30-year period. So this is not necessarily, just tied to the age of the building. The majority of these HHBs are also between 100,000 and 300,000 square feet. And one of the reasons that these buildings have been hit as hard as they have, many of them are in downtown markets, and the destruction in value is very largely due to an increase in crime in these markets. And that leads us to San Francisco. You may have seen the headlines here in the last 3 weeks or so, or heard the reports that there are major office buildings in downtown San Francisco that are expected to trade later this year at a discount of 70 to 75% to their 2019 value. I spoke with one of my debt colleagues at CBRE in San Francisco late last week in preparation for today, and he confirmed all of that for me, that yes, it is a combination of things that are pretty easy to understand. One, San Francisco is primarily a technology-driven city. There are a lot of tech tenants. A lot of tech companies are laying people off currently. Tech has not been quick to embrace a back-to-work mentality. So a lot of these buildings, whether they're leased or not, they're not occupied. And then third, the city of San Francisco has basically seen a significant uptick in the level of crime. And when those three things combine, you've got a serious destruction in the value of the office buildings in downtown San Francisco. We have finally gotten back to an office utilization of about 50% of where we were pre-COVID. It has certainly taken a while. You can see this kind of the light green line is our occupancy, and you can see as COVID cases spiked since February of 2020, each time we had a spike, we had a fall in occupancy. We've all experienced that over the last 3 years or so, but we're back nationwide to about 50%. There's some good news here. This is global dry powder. There are a lot of people with a lot of money who are very interested in investing in commercial real estate, whether that is in equity or debt. So let's talk about the office capital markets and where we are with respect to debt today. A few observations. The first, I do not think will come as a surprise to anybody. It is very difficult to finance an office building today. Just exceedingly difficult. And we'll get into the reasons in a moment. Seller financing is going to become more prevalent. We're starting to see that. And when sellers offer financing, they're doing it for two reasons. First, they're trying to enhance the purchase price of the building. And if they can offer particularly accretive financing, they will succeed in doing so. However, the more important piece is this may be the difference between actually getting the building to transact or not, just having seller financing in place. And I'm not talking about just a mezz piece on top of a senior loan. I'm talking about, you know, the full debt stack to support the purchase of the building. Another observation, the great majority of lenders, they do not want their property back. That's not why they are in the business of lending, and they want to work with the borrower to the extent that they can, but the lenders don't want the property back. And I would say also, you know, look for the return of extend and pretend. We'll get to the quantification of the extent of the problem here in just a moment, but extend and pretend is going to return. So with respect to these 4 different lender groups, we'll start with commercial banks. You know, why are they reluctant to lend on office today? There are various reasons. Many of the larger banks are mandated by the Fed. They simply cannot add to their debt book for office product right now. If they're not mandated by the Fed, many of them have their own internal mandates that they simply will not add to their office book currently. Some have concerns over their own balance sheets and their own liquidity. That's coming directly out of what we saw with Silicon Valley Bank. Some are concerned with their existing loan exposure, obviously just in office. And lastly, headline risk. Most people do not want to be the person who made the office loan when other people were not making office loans, because if that loan happens to go badly, you've got a lot to answer for. So headline risk is very real. Debt funds have some of the same issues as the commercial banks. They're reluctant to lend on office. They have their own office loan exposure that is concerning to them. But also most of the debt funds will sell off an A note to a commercial bank in order to make the deal work for the debt fund, and the commercial banks, as we just discussed, are simply not there. And then third, some of the debt funds, they use CLO financing to basically lever their own positions, and the CLO markets are disrupted right now. Moving over to CMBS, you know, CMBS can certainly make office loans, but office is being limited to 20% max of these CMBS pools that we see currently. And that leaves us with life companies. And life companies are reluctant to lend on office for a few reasons also. They too have concerns over their existing office loan exposure and have concerns about adding to it. But then also, life companies have multiple options in where to invest. And historically, you've seen them basically weigh A-rated corporate bonds as an alternative to commercial real estate mortgages. And then also they're able to make mortgages on other asset classes that are perceived to be less risky than office is today. That said, there are some commercial banks that will lend on office today. They tend to be some of the smaller banks. Sometimes that comes with recourse or partial recourse. Some of the debt funds still are able to quote on office financings, and CMBS, as I mentioned, does, and some of the life companies are as well. Give you a quantification of just how far the markets fell off. This is lending into all real estate classes from March 22nd to March 23rd. This is from CBRE research. You can see it fell by about 53% between the first quarter of 22, the first quarter of 23. Now, this next slide, these next 3 slides, this is probably one of the most significant messages that I would like to impart today. This graph on the left-hand side of this slide, office is this light green color, which is the lower line there toward the end where you see 2026. And if you go to 2019, you can see this was 100. The value index was 100. Today, in 2023, it's about 70, going back to that 30% loss of value that we've seen to date. So it's right in here. So we've lost 30% in value in offices so far. In addition to that, over on the right-hand side, the average LTV has fallen. Office happens to be this kind of gray-green color, which is the higher line there in 2020. That at 72 or 3%, I will tell you that's a higher LTV than my personal experience would provide for that time. But the message is the same. LTVs are way down. I would say the average office LTV now has probably fallen below 55%. So two things are working against us. One is there's been a tremendous reduction in value, say 30%, and also LTVs are down another, call it 10%, from 65 to 55 or 53, something like that. So the net effect is this. When it comes time to refinance these office buildings, there is going to be a very substantial piece of the existing capital stack that's no longer going to be there. And I'll lead to this slide. What CBRE did in evaluating this, they took loans that were made on office buildings in 2018, 19, and 20. The great majority of those loans had a 5-year term. So they expire in 23, 24, and 25. CBRE basically said, okay, given the lower valuation of these office buildings, this 30% value reduction, and the LTV reduction that is applied today, basically those two things are going to conspire for about 27% of that capital stack that was all debt to basically evaporate. So when it comes time to refinance these office buildings in 23, 24, and 25, something is going to happen to replace that debt. Now, some of it will come in the form of additional equity, but I don't think there's any way in the world additional equity is going to provide, this missing 27% of the original stack. I think you can expect to see some very, very difficult conversations between borrowers and lenders. These are already underway, and it's going to continue. You can see it's about a $20 billion shortfall in 23. That's this light green color there on the screen. 2024 is another 40 billion or so. And 2025 is roughly 15 billion. You add it all up, it's about $72 billion shortfall. And again, this was all debt in the original capital stack, and it's not going to be there when it comes time to refinance these office buildings, if indeed a refinancing is what's going to occur. Extend and pretend is going to make its comeback. 72 billion, by the way, this next slide, 72 billion happens to be the same number of the similar shortfall back in the great financial crisis. In 2010, 11, 12, for loans that were made in 2005, 6, and 7. If you run the same analysis, you find office was about $72 billion short, the same number we're looking at right now. However, 72 billion in 2012 is very different from 72 billion today, given the fact we've had about a 40% erosion due to inflation. You can also see here in this slide, multifamily, going back to the great financial crisis, multifamily was the asset class that had the big problem. And as we just saw today, office is the asset class with the big problem. Going back to the previous slide, you can see industrial really doesn't have a similar problem. Retail and multifamily, very, very small. Office is the asset class that's going to be difficult here as these loans mature. Now, office leasing, this is no small part of the issue that office is facing today. So let's get into some of the kind of office dynamics that apply today. You can see here these little navy blue bars. These are deal counts. These are number of leases in the first quarter of each year going back to 2018. And you can see 2022 was somewhat of an anomaly with a lot of leases signed. But if you look at 2023 and then the first 4 bars, 18 through 21, you can see the deal count, lease count has held pretty steady through the first quarter of 2023. But what is really concerning is the average lease size of these leases in the first quarter of 2023 those leases are 28% lower than the lease size pre-pandemic. And that is certainly concerning, because if we're looking for data points for what a post-COVID leasing world looks like as opposed to pre-COVID, this is starting to give us, some proxy. And, a 28% reduction in the size of a lease post-COVID is obviously concerning for the obvious reasons. But right now, these leases are about 28% lower than what they were pre-COVID. You can see another graphic here. You can see that net absorption continues to fall. Completions are falling also, which will certainly help. At least it will not, make the problem more severe. And vacancy is continuing to rise toward 18%. I find this slide particularly interesting. It goes back to the first quarter of 2008. it compares downtown vacancy rates with suburban. And as you can see, the downtown rates have been roughly 400 to 500 basis points less than what suburban vacancy rates have been until you get to COVID. And once COVID came, you can see these vacancy rates for downtown office increased much more dramatically than for suburban. And finally, sometime in the late 21, early 22 timeframe, downtown vacancy rates have exceeded suburban rates. And that's the first time in a very long time. There's also a very substantial amount of sublease space on the market right now. 23% of all that sublease space is in the technology sector. And we talked about San Francisco as an example just a moment ago. Staying with the topic of subleases and availability, you can see in 2022, 177 million square feet are available. And this is just sublease space above 10,000 square feet. So 177 million square feet at the end of 2022, almost twice the number that was available in 2019. Now, again, from CBRE Econometric Advisors, in late 24, early 25, we should see peak vacancy, and then vacancy will start coming back down. We will also see the trough of asking rents in the same time frame, late 24, early 25, and then rents should begin to climb back up. Vacancy will peak at just over 19% in the third quarter of 24. We'll get to full recovery of pre-pandemic rents third quarter of 2025, so about 2 years from now. However, it's important to note when we get to pre-pandemic rents, those are not inflation adjusted. If you adjust them for inflation, we're still about 15% or so behind. So let's talk about interest rates. Interest rates are no small factor when it comes to some of the value destruction that we have seen. I'm sure some of you have seen what we refer to as the hairy graph. This is from Chatham Financial. And I find this interesting, and people respond favorably to this each time I share it. This dark blue line, this is basically 30-day LIBOR going back to September of 2001. And then this dotted line over here on the far right-hand side, you can see that's basically when we converted over to SOFR. So basically, consider this 1 month LIBOR going back to September of 2001. These dotted lines, the hairs, if you will, those represent what the forward curve looked like at each of these points in time. So if you pick a point, like I'll pick, say, right here at this peak in March of 2008, this is where 30-day LIBOR actually was. And then here, this dotted line, you can see how it went down and then came back up. That was the expectation. That's what the market thought rates were going to do. In reality, it fell very steeply. The message here is it is very, very difficult to try to estimate where short-term rates are going. I mean, once you get beyond 3 months or 6 months, it's just hard. So with that said, what am I going to do next? I'm going to show you the current SOFR forward curve. It is the dark blue line right here. You can see this is where the market believes that SOFR is going to go. Now, these dots, these are basically the board of governors. This is what they think interest rates are going to do. And you can see the Fed believes that rates are going to be higher for longer. So that's the difference between the current Fed, where it believes we are, and where the market believes we will go. This slide is from Pinsford, and there are actually two messages on this slide, and one of them is pretty obvious. The other one is quite subtle. The more obvious of the two is this: we have had 4 interest rate peaks in the last 30 years. This goes back to 1992. So after the Fed has had a series of interest rate increases, and by the way, we're in the process of building the 5th peak right now, and maybe we're already at the peak. We'll find out next week or in the next few months anyway. But we've built 4 peaks so far in the last 30 years. And as you can see, after a series of rate increases from the Fed, once they hit pause, the shortest length of time that they have taken before starting to lower rates has been 5 months, and that was 1994. The longest period of time that they have gone after a series of interest rate increases before starting to decrease rates is there in the 2006 and 7 timeframe, just over 14 months. The average is about 8.5 months. So they don't tend to stop with a series of interest rate increases and then immediately start to reduce rates. It just doesn't happen. Even if we take the 5 months, the shortest of these four periods, and applied it to today, it would be the very end of this year before we would see any kind of interest rate decreases. It would be mid to late next year if you look at the 14-month, the most lengthy period. So that is the first message. Just how long do they leave rates alone after a series of increases and hitting pause? The more subtle message on this graph is this: as you can see, once the Fed hits pause, they're done. You don't see any examples of a series of interest rate increases followed by a pause and then another series of interest rate increases. It does not happen. So again, after we have a series of interest rate increases from the Fed, once they hit pause, they tend to be done. Okay, a few conclusions here. This when will we get back to the office question, it is unanswered. And until it gets answered, it is going to weigh heavily on anyone who is interested in office leasing or buying or financing. And we saw kind of some early indicators on the size of leases post-COVID, but this question is yet to be answered. Second conclusion from this, office leasing is going to be challenging through next year. It will begin to improve either very late next year and early 25. And I think we can all expect to see the same, that 34% drop in valuations peak to trough that I talked about a moment ago. The best buildings are going to continue to do well as tenants weaponize their office space. It's a retention tool, it's a recruiting tool, and there are tenants that are going to pay whatever they have to in order to attract the people and retain the people that they need. Number four, we may not be at terminal rates yet, at peak rates, but I think it's safe to assume that we are close. Once we get to terminal rates and people are comfortable that we are there, it will be easier for buyers and lenders to underwrite deals, because at least at that point, you understand you're no longer trying to underwrite a real estate deal in a rising interest rate environment. So at least at that point, we will know the next major move, or we would expect the next major move to be downward whenever it starts to occur. But at least we will no longer be in a rising interest rate environment. And lastly, this is the third time in my career that I have seen office go through substantial difficulty with respect to value and a mismatch between, say, supply and demand. Both times previously it was very difficult. There was a lot of pain. And yet there were individuals and groups that came out of this having taken advantage of the opportunity and having basically made very, very substantial amounts of money because they were willing and able and courageous enough to perform when others either were not willing, able, or courageous. So I expect there are going to be some very serious winners that come out of this difficult time, just as there have been winners who've come out of the previous times when office got difficult. I will stop with that, and I'll hand it back to you and Sarah.
Great. Well, thank you, Greg. People hopefully know this already, but we're getting some questions. I want people to continue to type them in. So when we're going to cover them all at the end, I just rather we get everything out and then we'll cover those. But you talked about people having, really difficult conversations with lenders right now. And I can tell you that the group of people here at First Service Solutions, that's what we do every day. And we are working with many, many owners of office buildings as large as $1 billion loan, as small, I would say, as a $10 million loan. And in all cases, the pain that they're feeling was so well represented by your slides there, Greg. I mean, they're feeling the pain that you just shared in this data. So what we want to share with you now from First Service Solutions side is the conversations we're taking that are taking place with the lenders and servicers, what we're hearing, what they're asking us. In a lot of cases, servicers are asking us what we're seeing because we see a large amount of these. And I don't think they've all bought into the extend and pretend yet, but we're trying to get them to understand that in some cases that we may need just time. Let's talk about, so we sat around together and said, okay, from all the discussions we're having and have had with lenders and servicers, what are the possible options? Some of these let's go back one slide to the list of 7 options, if we could. There you go. Let me tell you, and I get it, that it's almost like you went to the doctor and you have something seriously wrong and the options are surgery, chemo, let it go. I mean, these are not fun options, so we don't expect that any of them are going to feel really great. But I think there are 7 total. Seriously, we can't think of any others. One is, and we're going to go through each one in a little bit of detail, a little less detail on number 1, because you already knew, every owner knows that, but you could keep the loan current and ride this out on your own and probably come out fine at the very end. But let's go back to if we could, Sarah, to the just the list of the 7 options for a minute. And then you're probably trying to rush me along. And I didn't properly introduce Sarah. You'll see Sarah up here. Sarah is the one that there's always someone behind the scenes that takes care of the slides, setting it all up, making sure everyone's registered. And that is Sarah Walsingham. So Sarah, raise your hand. Thank you, Sarah. So you can keep the loan current. You could sell your property, but what's going to happen depending on LTV? You could potentially extend your loan. We're going to talk about this AB structure. I've spent a lot of time talking about that, I think in my sleep and over and over in the last 6 months. We're going to talk about future discounted payoff and what would warrant that versus a discounted payoff for today. And of course, the option on a non-recourse loan almost always is there, not as fun, but could hand the property back. So we're going to go through these, and I think we'll start with, so option number 1, and these are in no particular order, although I think I tried to put them in order of, I don't know that there is a real order, but obviously the last thing you'd want to do is hand the property back, arguably, and probably keeping the loan current. Everybody knows that. But let's start with keeping the loan current. And since Stephanie, let's go back one, since Stephanie handles all the performing side of our business, she's going to cover all the things you can do in a performing loan. And Douglas and I will cover the things that you do worst case. So Stephanie.
Sure. So we did touch on it a little bit, but your first option or an owner's first option is always you can keep the loan current, and likes to say all bleeding eventually stops. It's true. You can come out of pocket as long as you can until there's no more money. But as long as you do have the funds to do so, the option is there. You can continue coming out of pocket. The loan would remain as is, no changes, just try to ride it out and see what happens next. And hopefully the market improves before, funds run out. But that is option number 1, is to continue just as is, keep the loan current and request no changes, make no changes, just stay as is. And then I guess next option here is option number 2, sell the property. We have a little bit of a chart here on this slide based on LTV. I will say that LTV does not, in our opinion, matter as much as it did maybe pre-COVID or a year ago or 2 years ago, even 3. We're just at this point right now where the property itself and the ability to improve the projections, the potential performance really outweigh the current value. The current value, of course, is always what someone's willing to pay for a property. And right now, it's just very difficult to go out and appraise and come up with that real value here. So if LTV is less than 100, we believe options are you'd go through a loan assumption, have a buyer assume the existing debt, and or extend the maturity date based on the current maturity date. So again, LTV less than 100, go through the assumption process, potentially extend the maturity date if you need to. LTV greater than 100%, there are several options that we'll discuss in greater detail as we move through our presentation here, but a short sale, which is basically buyer funds discounted payoff, full on discounted payoff where current borrower stays in place, or a third option that we are starting to explore and see more of, like we did previously in past years, is a pay down write down, where borrower could potentially offer a sum to pay the debt down, and then lender writes down an equal to amount or some other amount to be negotiated. So those really are the options that we see based on LTV. Assumptions back to LTV less than 100% and LTV more than 100%. We do believe assumptions are possible if LTV is even more than 100% at this point. It's starting to gain traction with servicers and lenders. It's just a matter of exploring these options as we, work through our current market conditions. So again, I think I don't know that there are firm rules right now based on LTV, but this chart was put together to just explore certain options and lay them out there as rough guidelines. Our third option here is a loan extension. And there are a couple questions that we get asked frequently here on this slide. How much time can be granted? What are the potential fees associated with the extension? And what's required of the borrower? These are the primary points that we talk through on consultation calls and even work through while we're negotiating these loan extensions for borrowers. The first question, how much time can be granted? It really depends on the pool. If we're talking about CMBS, what we are currently seeing a lot of is a 1-year extension with the option to extend an additional year, so that as we work through the next couple questions, fees and requirements of borrowers aren't so egregious up front. So that's something that could be negotiated, is a year, maybe the option at the end of that initial year to extend an additional year. But it does really depend on the pool. So 3-4 years, it maybe up to 7. It just depends on what the initial term of that loan was, what the remaining term on the pool is, and also what's the future look like for the property. Is there some upside, or maybe, as Greg said, it's extend and pretend at this point? We're still trying to work through those options and seeing what's available to everybody. Next question, what are the potential fees? Special servicing fees exist anytime a loan is transferred to special servicing. So that would be a potential fee when we're working through a loan extension if the loan is actually transferred to special servicing. But usually, as far as the actual fee to modify the debt and extend, we see about 1% or 1 point per year of that extension. It is negotiable, so it's not a hard and fast rule, but that is usually if you're going to go and ask a servicer what they would quote for a year extension, that's what they would quote you. And then again, it depends on loan balance, what's going on at the property, and it is all up for negotiation. It's not a hard set rule. Third question on here, what is required of the borrower? Every deal is different. Right now, we are seeing servicers require contributions from borrower for either reserves, needs of the property, or pay down of the debt. However, we are seeing that we do have a couple of deals where there is a potential to get something done without that contribution. We're just not quite there. So what I guess I'm saying is we're all trying to work through this together in our current market. I think options exist. I don't think that every single deal is going to require a contribution from the borrower, but there are still a significant amount of deals that are requiring that contribution in order to get the deal done and have an extension granted by the servicer.
And remember that Stephanie was talking about if your loan's performing. So
Yeah, Absolutely.
Performing, so we're not talking about where you're underwater or, value's not there. Sarah, let's go to the option analysis page. One of the things that we're helping owners with the most right now, we're going to go back to other options in more detail here in a minute, although our time is getting a little slim. But one of the things I wanted to share with you, and we have a lot of owners that are coming to us asking for this, and we're just charging one small fee kind of upfront to run a real option analysis for you, which what we do is we take your property projections, and I know everyone says, well, how am I going to do that? But you do usually a couple options, base case, upside, downside cases, your projected capital cost, assuming a certain rollover or vacancy rate, the stabilization period. A lot of this, I get it, is guesswork, but there's some data that can be pulled together, and then market leasing data. We use that also. We put it into our model, which we created way back when. It's similar to what the servicers use to calculate their options. We call it our Jewel model. We used it a lot during 2008 downturn. And what it spits out, that's not the right answer, but what it comes out with is a whole bunch of stuff. But at the end of the day, what it shows you, and I just gave you a real quick idea here, is it shows you whether or not, to Stephanie's point, just extending is good enough, extend and pretend, whether or not you need to split your loan. If you have a DPO, you might get what capital might be required, what the return on that capital is. If you have a mezz loan, how that gets allocated. And at the end of the day, how does everybody get out? And we run various exit cap rates to kind of help you determine value at the end. So this is a hot product right now, and we're available to do it for any owner that's just trying to figure out, like, what am I going to do in 24 or 25, or even heck later this year when my loan matures. So now let's go to, I'm going to go through the sample A/B structure. I'll try to do it pretty quickly. Douglas, then you're going to go through a couple, and then we'll circle back to questions. I can see we've had quite a few questions come in. Okay, an A/B structure. Before you read the slide, the bottom line on an A/B structure is it was really created, I think, in the 2008 downturn. And what causes it to be necessary and a good structure is almost exactly what's happening in office right now. You've got a property that was otherwise performing, is underwater today. Take a San Francisco one, or the HHB, the high, geez, Greg, I forgot what that was, the high, oh, well.
The hardest hit buildings.
Hardest hit buildings. Thank you. I thought that was such a good terminology, and I forgot. Let's take the hardest hit buildings as an example. They're underwater today. It requires quite a bit of capital, no doubt, to stabilize or ride out the next few years and bring new tenants in. And yet a borrower likely, nor would any other capital provider, bring money in today above the over-levered structure. So the A/B structure allows you to sort of temporarily right-size the debt, put new capital in. The capital earns a preferred rate of return at market rates pretty much. And at the end, and the rest of the debt goes to what's called a hope note. You've probably all heard of it, a B note. And if you go to the next page, what happens at the end of the day, you get to the capital event. Sarah, if we can go ahead and go to the, yeah. So what happens on the liquidation day is the waterfall goes this way. You pay off your A note first, that right-sized note. You get your new capital back plus a preferred rate of return next. And then we address the hope note, and usually you split proceeds between borrower and hope note. So what happens there is you've got a delayed loss. You write out the time, because today nobody knows, as Greg and all the data showed, what is the value today? Who knows, right? So what we need is time. We need new capital, but no one's going to put new capital again in above a highly leveraged or over levered deal. So it gives you the opportunity to put money in, get it out at the end, get the lender as whole as possible at the end. And there's some incentive for the capital provider. The devil's in the details on an A/B structure. There's lots and lots of data that goes into it in detail. And that's where the option analysis really comes into play. So Douglas, why don't you talk now about this kind of payoff options?
Right. Another option and there's two that I'll discuss. This one here, a future discounted payoff. This is for when a property is currently the LTV is greater than 100%, and there's expectation based on today's market, the current market, that the value will not be there at the maturity date, but the property is currently cash flow. It's covering debt service. And in this case, the solution that we would propose would be a future discounted payoff at maturity. That is, that with time, that in the market's recovery, that an agreement can be made now between borrower and lender to agree upon a payoff at maturity based on a comparison of borrower's appraisal and lender's appraisal. And as long as those two appraisals typically are within 10% of each other, that will arrive or derive the payoff amount at maturity. So that's what we are calling a future discounted payoff. The other is more traditionally and frankly fairly common post-COVID here in our shop with a number of deals where borrower and lender agreed on a payoff at a discount. There's a near-term maturity date. There was no chance of recovering value. Lender agreed that the value was below the loan balance, and borrower was willing to execute on that to be able to close out that payoff at a discount. It can be executed multiple ways. One is a short sale. We described that earlier. That is where a current owner sells the property with a buyer paying off that loan for less than the balance. It can occur through a lender handled or lender executed sale of the note, where the existing borrower owner will effectively get a new lender, but with that lender obtaining that loan at a lower balance. So this solution number 6 that we're going to cover, and I think we've got one more.
And that is worst case, or maybe not. Some people come and call us and say, this is what I already know I want to do. And on a non-recourse loan, you can hand the property back. So the only thing I want to say there is beware of your carve-out guarantees. Some of them are super clear and egregious, bad events, intentional, and all that. And others are kind of subtle. So you have to reread those carve-out guarantees. Be really careful you don't trip one accidentally and make it recourse. But otherwise, you can hand the property back. We can certainly help people with that if they want. And you really, the benefit to handing the property back is that it's now the lender's problem. We have an option on here, which I won't talk about because we're out of time, but there are times where, we have people approach us that say, hey, if you ever run across a situation where someone's handing a property back and it's, hotel, I would love to buy it. And so there are times where we can actually do an off-market transaction and connect a new, potential buyer with the existing owner. But point is, you can hand the property back. That's not where we'll spend our time today. I'm going to ask Sarah. It looks like we have quite a few questions. We've got 6 minutes left. Why don't we go to the questions? And again, I want to make sure everybody knows, without a doubt, the best thing to do if you have any questions about your property is call us. Let us do a consult call, and particularly let us run an option analysis for you. Those are what you really need. Just like you go to a doctor and have a test run to rule things out. That's what you really need here to understand your real options. Sarah, what's our first question?
Yeah. So our first question was from Carl, and it is a question for Greg. He asked if the Fed paused their increases, or are they merely skipping an increase so that by doing so they drop their standard 25 base points increase to an average at 12.5 base points by spreading a single increase over 2 months instead of 1 month?
Yeah, interesting question, especially to take 25 and basically call it 12 and a half over, twice as long a period. If they pause and then choose to increase again, it will be an anomaly, as we saw on that slide over the last 30 years. If they do, though, they could pause. Let's say that there is no rate increase next week at next week's meetings. And basically the data just keeps coming in so hot that they basically say, we've gotten more information, and they get to the July meeting and they say, now we are going to raise again. Again, that will be a different behavior than what we've seen in 30 years, but they're very information driven. I like Chairman Powell a lot. I think he speaks in words that I can understand. He's been emphatic that they're going to kill inflation. 2% is the number, not 3%. And if recession comes as a cost, then so be it. So if they do pause and do like Carl is asking, if they do pause, wait a meeting and then increase again, it will just be because of the information they've received in the interim. They're very information driven.
Right. And then Greg, I think this was also a question for you, but anyone's welcome to answer. Do you think the industrial market will continue to be a favored property type for the next 5 to 7 years, or are there headwinds facing it as well?
I'd love Greg to answer it.
Okay. Well, it's been a favored asset class for a long time, both equity and debt. 5 to 7 years is a pretty lengthy period of time. So I don't know that I would want to go out that far, but as the internet continues to become a bigger and bigger part of our lives, I would say that I would expect the industrial to do quite well.
And then what are your thoughts as to ESG and green as it relates to occupancy and value in buildings?
I'll take that one. I think I believe that it's a flight to quality. I think it's a factor for corporate users in selecting where they want their employees to reside. So I believe it's a value add, and more and more important as corporations react to investor requirements.
And then this question is from Charles Haddad. He said, "Great to see you all." Said, "What details of workouts for balance sheet deals are we seeing or expecting?"
I'll take that one. There was a day, and I never thought I'd say this, but Charles, you were one of the first one we worked on with this, where I always thought that CMBS servicers, and I defend them, believe me, I used to be them, and they're just doing their job, but I used to think they were tougher to get a deal worked out on than a bank and a relationship lender, right? Because you could call up your lender and you know them, and you could just you had a little more flexibility there, but I think we're finding it opposite almost this time. I'm finding that the CMBS servicers are very clear that their options are either work in the situation with the hands we're dealt, or take it back and then do it all myself. And that's not a good solution all the time. But I'm finding the banks to be a lot more difficult to work with. And I don't know if it's because they just have such strict requirements about get out. I mean, when you got an office deal that's mature, I don't care what the problem, get me out. I don't want, and I don't know, but that's what we're kind of finding is, I don't know if there's any data to show that, Greg, but that's what we're seeing and feeling in here and dealing with every day. So I'd say whether you have a bank loan, CMBS loan, doesn't matter. I mean, you got the same situation. So I know my team would all agree. Greg, have you heard anything to the contrary?
No, I would say one quick add that we are seeing from commercial banks, and this is pretty new. If they are willing to make a loan, office or otherwise, they are expecting deposits to come with it. And it's not just the operating account of the borrowing entity. It is real cash from the sponsor. And we are seeing that more and more from commercial banks today on all sorts of different property types.
Good
Sarah,
input.
it is 11 o'clock. I'm very
Okay.
diligent always about starting and stopping these on time. I know you all have a busy day. Appreciate everyone's attendance. You can email us. Sarah, are there more questions that we didn't answer? I don't want you to read them, but.
I would say there's only 2 left.
So we'll take any other questions you have. We'll reach out to the 2 that asked, and we'll make sure you get answers your questions, but I'll do it outside of this group webinar. I want to thank you again, Greg. This was very, very informative. It's always nice to see the data behind what we're all feeling. It's kind of like no wonder we're all feeling this, and appreciate your time today. And again, appreciate everybody logging on. Our next webinar, Sarah, is, geez, we should have thought about this beforehand. Do you have the date?
It's August the 8th.
Wonderful. So if you guys could all sign up for that. At this point, we're going to continue to talk about Office because it's the darling property of the moment. And so if you want to sign up for our next webinar, we're going to again be talking about Office. We'll all the time have different updated information. So thank you, everybody. Appreciate it. Have a great day.